Hi everyone, my name is Kaustubh Kale. I hope you guys are doing fabulous. So today on the fifth day of Navratri, we will be discussing something that is very close to my heart and something which I love to trade, derivatives. Now derivatives are typically high risk instruments which are traded on the stock exchange. There are some derivatives which are also traded over the counter, but we will not be talking about them today. We will be talking about those derivatives which are traded on the stock exchange. Now what is derivatives? Derivatives derives its prices, the instrument derives its prices from other asset classes, or rather other assets which are traded on the stock exchange again. They are of two kinds primarily. One is futures and other is options. Since this is a shorter video, I will not get into the depth of futures and options, but we will understand and analyze it in the four parameters that are there. The first parameter is liquidity. Now, being traded on the stock exchange, it offers great liquidity and you can easily square off your positions or exit the positions or enter into a position. So liquidity is not a problem here unless you go for some stock related futures or options where the liquidity may not be higher. So the liquidity in derivatives depends on the asset or rather the instrument that you're trading, whether it is stocks or whether it is index. Index generally has a higher liquidity than stocks. The next point is time horizon. Derivative contracts either expire monthly or weekly. There are even farther term derivative contracts, but typically monthly and weekly is what is traded more frequently. Being a monthly or a weekly traded contract, the time horizon is typically less. Traders trade derivatives from a intraday standpoint, also from a overnight standpoint, also. They also trade it from a positional standpoint. So this is about time horizon. Now, where is derivatives exactly used? It can be either used for an independent trading strategy that you develop, or it can be used to hedge your portfolio. So what is the risk that you're carrying? Depending on your strategy that you have to backtest it to understand the drawdown or the risk that you're carrying. It is something which involves a lot of research, entry rules, exit rules, backtesting of the strategy, updating the strategies. So your risk will be dependent on the strategy. To be very honest with you, derivatives carries high risk because it's such an instrument which can also blow up your trading account. So you have to be careful or you have to trade with the advisor's help there. Now, coming to the returns, obviously, since the risk is high, the returns are also high, but depends on probability. So your returns will develop, will also depend on the backtesting strategy that you follow, which instrument you trade in, whether it is futures or options or a mix of both, and which contract it is based on, whether it is based on index or whether it is based on stocks. So there can be multiple parameters, permutation combinations. The thumb rule or the basic summary is higher returns, higher risk, very good liquidity, very technical in nature, and shorter time horizon. Hence, you have to be very careful with it. But if you develop a good trading strategy and follow a good risk management process, then it's a very interesting instrument to trade. Thank you so much, everyone. This was all for today for derivatives. Tomorrow, we'll be discussing about unlisted shares.